Well, hello, friends. This is Jerry Robinson from followthemoney.com, and very pleased to be joined today by my good friend and longtime precious metals advisor, Tom Cloud. Today, we're going to be moving into our precious metals 2023 outlook. Tom, it's great to have you with me on the line today. Great to have you, and I'm looking forward to hearing some of your insights on gold and silver as we move ahead into the new year.
Thank you, Jerry. It's always a privilege, and I love your clients because they really care, they really want to know, and really want to dig a little deeper. And that's what we're here to do, is give some forecast outlooks and dig a little deeper into what they need to know.
You know, it's been a while since we've actually done a webinar, style interview like we're doing today. And I think this is going to be great for those who are interested in the precious metal space, especially as we move into this year of 2023 after a really strange year in 2022. We'll be able to really provide some insights. And our goal today in today's presentation is to really provide an outlook for you, to show you where we see precious metals today, what we're looking at right now, some of the macro factors that could drive gold and silver as we head into this new year. Also take a look at where we've been and how that could inform future investment considerations. And by the way, this is brought to you by followthemoney.com. So if you're listening to this on YouTube or Facebook, you can learn more about our work at followthemoney.com. There you'll find not just all of our work, but also Tom has a precious metals market update that he does right there on our website, also on our YouTube page. Tom has been providing those for many, many years. Before we get started, I want to remind you that you're investing at your own risk. Obviously, this is for your education and informational purposes only. You should always talk to a trusted financial advisor before you make any investment decisions. Please understand that what we're doing today is we're educating and informing you on what we see. Your decisions on how you should respond to that are entirely up to you. Invest at your own risk. Real briefly, for those of you who don't know, my name is Jerry Robinson. I'm an economist and author, the founder of followthemoney.com, a financial education firm. We've been online for many, many years, over a decade now, serving clients all around the world. We author of the book Bankruptcy of Our Nation, which is really pertinent to this topic, Tom. I mean, it's all about the fact that we are spending too much, and we know that the U.S. Government is spending money like a drunken sailor, which really builds the case for things like precious metals and other tangible assets. I'm also the inventor of the Profit Tracker system. For those of you who are familiar with Follow the Money, we have a trend trading system and software that we've created that allows you to identify buy and sell signals, uptrends and downtrends in any market, any global market, any commodity, any currency, any stock, anytime. So that's all available to you at our website. I also want to introduce Tom, as we've already been talking. He is a precious metals expert. He's served clients around the world for more than 40 years, and he's the host of Follow the Money's Precious Metals Market Update. Tom has a wealth of knowledge when it comes to hard assets. Gold and silver have been a major specialty of his, but he also deals with palladium and platinum. We'll talk about platinum also on today's webinar. And also, Tom has vast experience in gemstones and diamonds. And so we won't really be talking about that today. Today's really more about precious metals. But just know that Tom has a very comprehensive background in this hard asset space. And Tom, why don't you give out your website as well? I don't have that here on the screen.
It's cloudhardassets.com.
Cloudhardassets.com. That's a great place to go and find out more about Tom and all of his work. So Tom, I want to hand things over to you for a minute, because you're dealing with clients on a daily basis. You have seen many different cycles as we have lived through the last several decades. Wild time that we had in 2022. And before we began this recording, you and I were talking off the air about this mega trend that has changed. And we have a chart here that you had shared with me. Why don't you talk about what this chart is telling you and how it benefits those who are watching?
Being around this business, Jerry, for, like you said, 46 years now with my own firm, this mega trend is the biggest one I've seen, because a lot of mega trends are 7, 10 years, then they go the other way, then 10, 7 years. We have been in a downtrend for interest rates since Jimmy Carter left office in 1980. We have been in a mega trend going straight down. You can look on this chart and see in 1981, interest rates peaked out at 15%. I can remember buying my first home in Atlanta, my wife and I, in 1979, and we had an interest rate of over 10% buy a house. So what we've seen is we've seen firms, these big firms out with thousands and thousands of employees that are in the fixed income space, where there's either government securities, there's corporate, there's municipalities. Everybody's in debt. Everybody wants money. Everybody needs money. So what happened is when this trend was going down, bonds are going up, as interest rates went down. But we came to an abrupt stop just a few months ago when the Fed saw these inflation rates and had to come out. We've seen something like 20-something thousand employees fired from these major Wall Street firms in just a few weeks. And it's going to get worse. There's nobody, it takes a lot of employees to run these fixed income products. But here's the worst part, Jerry. The people that are seeing this are my age. They're in their 60s and 70s and 80s, and they've seen this ride. But people in the financial industry, they're in their 30s or 40s, they've never seen it. They've never seen an environment of rising interest rates. They've only seen an environment of throw anything against the wall in the fixed income space and you make money. So you're battling right now as an investor the biggest trend change to the upside that's been in my 46-year career. What are you going to do about it? What's anybody going to do about it? They've got to look at it completely different than the bond field. You've got to look at different financial instruments out there. I'm not telling you to get 100% out of bonds, but I can tell you you're going to lose money. I mean, we've seen some bond indexes, some of the biggest come out last year losing 20 to 25% on total return bond funds. I mean, the big. So get used to it. That's where we are. You can look at it, you can identify it, and do not let anybody talk you out without doing your own research. It's your money. You worked hard for it. You want to keep it. Identify the mega trend right in front of you and start talking to your trusted advisor. We'll talk to you about the metals part of it and what we think, by calling our office and talking to Dan or Catherine or myself. So anyway, that's what this graph's about. And it is a very important graph because if inflation stays up there, you're going to see interest rates continue to rise, and even it's looked like we'll get one more uptrend in February or March, and then the economy probably will not be able to sustain many. So you may see a little level out in this trend, but the trend is still up.
Tom, this has been, you're making a very important point. This rally in the 30-year Treasury yield, which decimated 30-year Treasury bonds, and those who were holding them found that out last year. It felt like they were holding a tech stock whenever the 30-year bond, collapsed 20 to 30% last year. That is really absurd when you think about it. But of course, as you pointed out, the bond bubble was huge, and it was definitely due to be deflated. But when you look at this surge in interest rates, you just simply can't find anything on this particular chart that looks like this. I went back and I looked at the actual numbers, Tom. The federal funds, the effective federal funds rate that the Federal Reserve sets, that's the interest rate that they're tweaking all the time and announcing on their policy statements. It began the year of 2022 at 0.08%. By the end of the year, that number had raised to 4.33%. Now, when you look at that, you would say, well, the 4.33%, that's really not that high. I mean, relatively it is, and historically, we've certainly been above that level. But when you go from 0.08% to 4.3% in 12 months. When you look at the actual rate of change on that, that's a 5,300%. I think it was like 5,300% increase in the effective federal funds rate. And so that same kind of rate of change was occurring in many different yields, and that simply decimated, so many different companies, especially growth companies, companies that maybe weren't earning very much money, and that, or maybe were dependent upon, borrowing. This was just devastating, as we all know. We all lived through 2022. And Tom, I want to talk a little bit about the dollar. I want to get your comments, but I want to just show a few charts here before we get into gold and silver. We're going to talk about gold and silver and a little bit about platinum today, so stick around with us. But before we do that, we want to talk about the dollar, because those of you who know about gold and silver, you understand that particular investment theme. Well, a lot of it has to do with the dollar itself, because this is what we denominate gold and silver in here in the United States. Well, here's a chart of the U.S. dollar, and what you're seeing are two different lines. You see a 200-day moving average, and then you also see a 50-day moving average. And back in 2021, whenever an asset crosses above the 200 line, 200 SMA, that's usually a bullish moment. So that broke out back, in the summer of 2021. Well, then we had this big mega rally in the dollar, which coincided with that rally in yields, because rising yields benefits the dollar. That's the price of money. And so as we can see, this price is bouncing off of the 50-day. Just every single bounce off of the 50-day was an opportunity to add long to the dollar. But it finally peaked out about 114 back in September, and then we began to notice it started to curl over. Now, this is about the time that the rate hikes really began to be noticed. And also, investors really began to realize, okay, the Fed's not messing around. It's really going to continue to raise rates, but also it's going to have to come to an end. And as inflation began to ebb a little bit, we began to see some pullback in the dollar. We actually fell back below that 200-day moving average on the dollar for the first time since that breakout last month. We're actually doing this particular webinar in January of 2023 at the beginning of the year. So last month is when we actually saw this breakdown, and we see the dollar is continuing to break down now after hitting that 114 high. Now, we're of the opinion that the dollar has likely peaked for this cycle, which really bodes well for gold, because a rising dollar, of course, puts pressure on gold. And if you look at the Fed's rate hike cycle that we endured in 2022, it sent the U.S. dollar to a 20-year high. We hadn't seen this since 2002, but now we're falling back. And it's our estimation, and we could be wrong, we're simply just providing an outlook here, but we believe that the U.S. dollar index could be back at the 88 level, around 90 to 88, somewhere in there, within the next 12 to 18 months. Tom, I'd like to hear your comments on this, but the Fed has really abused its privilege here. And when we think about what happened with the rate hikes, we realize that these rate hikes didn't have to come so fast and furious the way that they did. Instead, this was a kind of a mechanism of the Federal Reserve's failure to understand that they were unleashing inflation and inflationary pressures through their policies. And by the time they finally woke up and realized what was happening, they had to play catch up and raised interest rates something fierce in 2022, whereas this could have perhaps been a bit more smoother. The Fed could have realized that it was stoking inflation, and it could have begun to temper that inflation by raising rates well earlier than they did. But they had to play catch up. And so this really, quite frankly, Tom, even though we've had a crazy situation with the COVID-19 economy, we've had the Ukraine-Russia war, which has devastated people, and then it's also crimped supply chains. We've also had China closed for practically 3 years. But when you look at all of this, you realize that the inflation is largely due to the Federal Reserve's own policies. Like they literally helped create this crisis, and now they're trying to unwind it. So, so what do you think about the dollar, as you look at it? Because we're looking here at a chart since 1980, and what we're seeing, Tom, are lower highs and lower lows. We see a high back in the early 80s. Then we see another high at the beginning of the 2000s. And then we see another high that was reached in 2022. But each of them are lower than the previous. And we also see something happening on the low end. So, just back to what we were saying, I think we're going to see a lower dollar, into 2023 and beyond, because the Fed has abused its privilege, and many countries around the world are really done with this. They want to move on and perhaps find another kind of global reserve currency that isn't at the behest and under the control of the Federal Reserve, which has proved itself to be, undisciplined, and proved itself to be, kind of asleep at the wheel.
Absolutely, Jerry. And when you look at these economic indicators that we look at to forecast and give an outlook, being around it a long time, there are certain numbers where you remember exactly how the markets reacted, and you go back and you see in the year 2000, we were saying that the dollar was 72, but it then went up from 72 all the way up to 112, as you said, just in the last few days. So what happens, we know that on a basis of 1%, every time the dollar goes down 1%, gold will go up 3%. The good news is when the dollar is going up, as we've just witnessed, it doesn't not go down 3%. So that's how you see these big movements in gold. And we think certainly everything we've talked about the last few minutes is evidence that gold is, without question, one of the most important assets you can have in your portfolio in this kind of environment. And just since the dollar hit 112 and come back down to 102, 103, it's dropped 9%. What has gold done the last 2 months? Doing the same thing. It's gone from 1,700 to over 1,925, a direct drop correlation to the dollar. So it is a wonderful, accurate indicator in my world. And what all the stuff Jerry said, the technical side of it is right on. It's right on. But when you start plugging assets in to these moves, you see how important it is. And when you see people moving to the sidelines, and this 3-year rally has been people scared to death and moving out of equity markets and moving into fixed income. They're tired of the risk. They're not going to take the risk. They're going to wait it out. And that's what you see in this, is makes the dollar go up because they can attract more money as money's pouring in for safety could be the short term or even the longer term. But the dollar has broken. I look for it. Jerry's got 88 is where he's looking for it. I'm looking for it to go to 92 on this new move. And so we're very close on that. And when it gets to 92, it could go into a free fall. The dollar could. And a lot of it has to do with what's going on today, January 19th, as Congress and Senate are going over to not put business out, the government out of business tonight at midnight. So you've got to look at this, and that's a can of worms. When you start talking about a country that's bringing in $5 trillion in taxes, and they're wanting to spend $7.5 trillion, it's always worse than they say. They're wanting to give the worst deficit in world history right today than we've ever had, and have a $2.5 trillion budget deficit, and we're expected to live with that. So, I mean, all this stuff is coming. And the other thing, Jerry, and I'll go to another subject, is it's coming. Digital currencies are coming, and currencies backed by either gold partially or full is developing every day in the BRICS world. China, Brazil, India, all these BRIC nations, they're looking to decouple from the dollar in not the too distant future. I don't have a date, but when it happens, you'll see your hurt if you're in the standard old place you've always been, which gives you more reason to do your homework and get what I call right now diversified confidence. I think it's the most important statement I can make to you is you've got to have confidence where you're putting 20% for this, 20% for that, 15% for that. You're filling in your own playing board. You're playing your own chess game. But the bottom line is, think about it, diversified confidence. Until your portfolio has that diversified confidence, you need to keep readjusting it and getting it into percentages that if one goes down, the other comes up. And I'm going to make one other statement and we'll pass the time back. But I think that the statement that you're looking at with gold, you've got to look at it as insurance, and we'll talk about it a little later. But what I mean by that is I had an investor the other day who's worth tens of millions of dollars. And he said, the thing I love most about gold is the only insurance premium. He said, I lost 24% last year on my equity assets, 24%. He said, my gold went up 1%. He said, when you're buying insurance for your life, for your car, for your boat, for health, anything, you hope you never use it. You pay millions of dollars of premiums over your lifetime. Gold is the greatest because it's an insurance policy that gives you all of it back plus a profit, or all of it back with hopefully a very small loss. So you're buying insurance against the equity and the bond market, and you were very pleased, in my opinion, for 2023 that you'll get back a lot more. Your diversified confidence that you put in gold will do very well.
So true. So true, Tom. And then you also have no counterparty risk whenever you own the physical gold in your possession. You don't have the default risk, and you have the liquidity, as you have mentioned. It's easy to sell your gold. It's not, not difficult. It's liquid, a highly liquid asset. By the way, if you want to talk to Tom Cloud's office, as I mentioned, he's been, providing and dealing in gold and silver, palladium and platinum for more than 40 years. And his office is extremely proficient. And their prices, Tom, your prices are just fantastic. And they really are. And so people who are listening to this who say, I might want to talk to Tom. I'm thinking about buying gold, or I currently buy gold, and I'm thinking about, switching where I buy it. They need to give you a call, 800-247-2812. And we'll talk more about that later. But do want to encourage people if they're listening. And by the way, if you mention Follow the Money whenever you call Tom's office, or Jerry Robinson, or this video that you're watching, you'll also qualify for free shipping and insurance on not just this order, but every order that you have in the future. So encourage you to do that. Now, Tom, you have another chart. We're going to get into gold now because we talked about yields. We talked about the dollar. We talked about a little bit of the global economic conditions that were kind of fostering this. Now, let's turn to gold proper. Let's take a look at it. You have this chart here that goes back to 2003. Why don't you talk a little bit about the current trend in gold, in your opinion?
If you go back to 2000, it's not on this graph, gold was at 256. Today is at 1925. But on the way there, you can see the uptrend that's developed. It's like the highest goes to a new high, and we think we're very close, as you and I talked about before the show, that when we get to 1950 on here, we've got a trend that we think will break through it and go up to the 2060. That is the all-time high that we reached in 2011, briefly in the fall of 2011 when we hit that, and then we saw the contraction, and then we've seen the uptrend. But what's going on now, Jerry, we'll get into some of that, is now that central banks can own gold, and we'll get to that in a little while. But right now, people are realizing the United States is not the cat's meow. In fact, we're moving the wrong way economically. We're running the biggest deficits in the world, and we're not buying gold. And we do we have all the gold in Fort Knox? 6,812 tons they say we have. I don't know. I have no way of knowing that, but a lot of people think we really don't have it, which would put us really in a bad position. But right now, strictly on this chart of a trend, we feel that it's bounced off and it's going to move higher on the foreseeable future. We think we'll take out a new high this year of over 2,060 in my outlook. And even though where we are right now, that may not be but 10% away, it's still important to take it out and see, because of all the things developing worldwide. But there are trends with backing currency and central banks that we'll elaborate on in a few minutes.
Let's talk about gold and some of the factors that really, are kind of building to create what may be a very good year for gold. First of all, we have elevated central bank demand. That is actually quite staggering when we take a look at what's been happening at the central bank level. And I'd like to have your comments on this, Tom, but I'll just go through these briefly, and then I'd like to hear your thoughts as well. But we have elevated central bank demand for sure. We've been seeing an increase in central bank, whether it's Russia or Turkey. You look around the world, China, they're buying, especially China, they're buying lots of gold. And when you think about central banks buying gold, we've heard this before, but they're not stopping. So some people say, yeah, central banks buy gold, and that makes sense, but they're buying more and more and more. So these are the people who know what's going on in the economy. If you want to know who really knows what's happening in the global economy, you have to look at the monetary policy makers. That's their living. That's what they do. And so they know what's happening, and they want lots and lots of gold, apparently. And the World Gold Council has made this clear, that they're continuing to see ramped up demand from central banks for physical gold. You also have mining output that peaked back in 2018. Now, it's not like, there's not going to be enough gold for this year or next. It's not that we're in a massive deficit or anything. It's just the fact that mining output is difficult. It's difficult to mine gold, and to continue to find new discoveries and to continue to pull it out of the ground in an environmentally friendly way and to deal with all the regulations. I mean, it's complicated. And so when mining output appears to have peaked in 2018, that really bodes well, when you consider supply-demand, issues. You also have the rate cuts ahead. We've talked about that. The interest rates won't go up forever. And we know that there's, things go up, they also go down. And we know that interest rates are going to simply have to come down as we head into a new presidential election cycle here in the United States. They don't have a tolerance for high rates. Businesses don't have a tolerance for high rates. Consumers certainly don't have a tolerance for high rates. So they can't leave these rates here forever. They're going to have to try to bring them down. And we may end up with just elevated inflation and have to deal with it. And then also tailwinds from a falling U.S. dollar. As we've already pointed out, we expect the dollar to come down. And as Tom had pointed out, every time the dollar falls by 1%, then you can expect gold to go up by some factor. And Tom has pointed out that it's around 3%. So therefore, you have quite a few tailwinds here that are pushing gold as we head into the future. Do you want to add to this, Tom? You want to add any commentary to this?
Yeah, it was a wonderful overview you gave, and certainly you can't talk about the central banks enough, because they can now own it through the Basel III agreement and run it on their balance sheets at spot prices, which they could always buy gold, but they couldn't run it on their balance sheets at full value of the spot price. So this has changed everything. It's going to make the volatility in gold go way down over the next decade on this as central banks get more and more involved. And like you said, Turkey and Russia, India, Brazil, and China came out smoking 2 weeks ago, and you already see gold up 5% this year, 5% this year.
Mm-hmm.
But mining out peak speaks for itself. Rate cuts you did a great job on. And the tailwind from falling dollar is huge. And that's where I think you'll see drive. While I'm telling you 1,060 is the lowest price I see based on different factors, my heart tells me it's even going to be more than 9 or 10%. Even though it's already up 5, I think there's a good chance we'll see it get to double digits, even in the first quarter or second quarter of 2023. You cannot believe the demand and our sources in the wholesale market trying to buy gold. I mean, premiums have gone up because the wholesale market can get it. And it tweaks your market, pay a little bit more in premium. But we've done a great job of keeping premiums down and staying in touch with our suppliers to look for any good deals we can pass along. So the tailwind will be the major story because interest rates have got to, when they start down, you're going to see the U.S. dollar go down and you're going to see gold go up.
You know, one more thing I might add to this list that I would add had I had the chance, now that I just think about it, is also the jewelry demand. I was thinking about jewelry demand. You know more about this than I do, Tom. I was just looking at the World Gold Council. I saw that, the third quarter of 2022, gold jewelry demand was strong, and especially in China. And China is reopening now, and they've been closed for 3 years. So as they reopen and continue to do that throughout the year, we're probably going to see an increasing amount of jewelry demand. China and India compose like 60% of global jewelry demand. And so that could also be a big tailwind as well. In addition to the investment demand, that jewelry demand could also just continue rising, which the trend seems to be intact. If you look at gold prices over the last several years, this is the annual change over here on the far right. You'll see that you can look at this particular column and you can see how has gold done. So over just going back to 2015, you can see there's quite a few green years. You do have a couple of down years. 2015, we saw an 11% decrease. But overall, when you look, you see overall we have pretty good, strong figures here. And this is largely due to the fact that there continues to be demand for this type of asset. In the middle of all of the debt spending, of course, that we see. And if you look at the average annual return by assets, you would say, well, what does gold do, over time? Well, if you go back to the 1971 Nixon shock, August 15th of that year, whenever Nixon closed the gold window, and you say, well, how has gold performed every year on average since that time? Well, that number is around 7.8%. And when you think about 7.8%, that's a very fine return for an asset that doesn't pay any kind of dividend. It doesn't pay any kind of interest. It doesn't pay a yield. And so that's really powerful. It certainly outpaced emerging market stocks. It certainly outpaced U.S. bonds in aggregate. It certainly outpaced just holding money in cash. So while you could go and say, well, you could earn a little bit more from stocks or other things, that's true, but then you also take on more risks. So I think the risk-adjusted returns here are pretty appealing, I think, at 7.8% going back for 50 years or whatever this number is. So you really do have something interesting there. When you look at the charts here, I want to talk about gold on the charts. And Tom, feel free to chime in at any point. I'm just going to talk for a minute about what we see on the charts. Gold, if you're a trader or more likely an investor, of course, you do like to see your asset above the 200-day moving average. We talked about that again. For those who are not technically inclined, this is just a line that includes the last 200 days of price action, and it smooths it out on a chart so you're able to see it. Well, obviously, when you have the opportunity to buy below the 200-day moving average, that's often good if you're a long-term investor looking for a deal. Well, we just recently saw gold crawl back above its 200-day moving average. And this is often a good sign that especially as we enter a brand new year, that could be setting up for a nice rally. You also see that volume has been kind of rising here on the charts, moving in a right direction as it forms this new rally. And we also noticed that it really held strong at the 1625 support level. So those who follow gold, that we came down and almost did like a triple bottom there, or a double bottom, right off of that area, and then really began to resume up. Right now, as we speak, we also have what we in technical analysis is known as a golden cross. That's where the 50-day moving average crosses above the 200-day moving average. That often gets media attention, and retail investors will be excited by that, so that's also positive. In the near term, we're looking at 1875 support, which was really a pretty key area of resistance when you go back and take a look on the charts. But we were able to retake that area on larger than normal volume, indicating that there is quite a bit of appetite right now for gold as we're heading in to the new year. If you look at a weekly chart, you'll see that we also bounced from the 200 weekly moving average. So this, again, the 200 is an important number when you're using charts. It's a really nice number that gives you a pretty comprehensive idea. So if you turn a chart from a daily into a weekly, and then you apply a 200 moving average to it, well, it'll be 200 weeks. So that really kind of tells you, a lot about where the asset has been. And right now, that 200 weekly moving average is rising. That's very bullish. Also, we did come down and test this area back in the end of 2018 and early 2019, and that was an excellent opportunity to add gold at around 12 to 1250. So we saw a nice rally after that, come up to nearly $2,100 back in mid 2020. And then we came back and touched that 200 weekly moving average again. That was back in the fall of 2022. And then we rebounded it from it again, similar to this. So we could be setting up for another nice rally. But notice overhead now. We have this 1950 area, which is really going to prove a technical level that could be challenging. We're watching that 1950 resistance area. You can see a little bit better here where we have certainly rallied off of that 1625 support. We had those three touches of it. We got past the 1750 area and then the 1875 area. And the next real big meaningful area here is going to coincide with this 1950 level. A breakout above this, Tom, in my opinion, on higher than normal volume will very likely suggest that we have more upside ahead. You can really see it also on this monthly chart where we've tried at this 1950 area a couple of times, and now we're going to try it again. So we really want to see a breakout above 1950. Now, by the way, technically speaking, if we don't break out above 1950, that's not a deal breaker for gold. It doesn't mean that, gold's not a... So if you're watching this, say, in February or March, a couple months after we did this, and gold has yet to break out above 1950, well, consider yourself lucky, in my opinion, because it's going to, in my opinion, eventually break out and form a brand new high. Tom, let's talk about what you see when it comes to gold. When we say new high, obviously that would mean 2100 or so, but where do you think gold could ultimately resolve in this new pullback for the dollar, and as we're kind of moving out of the COVID economy and moving into this eventual pivot by the Fed? What's your target price on gold as we move forward?
It's funny, Jerry. Every time I talk to Europe about what's going on, some of the best information I get is from people we know in Europe that trade, and they're saying we hope it doesn't go up too fast because there'll probably be something like a Chinese yuan currency backed by gold. It may not be 100% backed by gold, but it could be 50% backed by gold. But what happens to the U.S. dollar the day there's a new currency and the BRIC nations demand payment only in that new currency? So I can give you numbers that are talked about over there when you get into the 8,000 numbers, but that is not based on the economy the way it is today. That's based on the U.S. Dollar losing its as a reserve currency worldwide. Jerry, you and I have been talking about this for over a decade. I can remember you coming to St. Simon's, and we talked this over 10 years ago.
Yes.
We talked about that doing. So here we are closer to it. But if the people that want to keep it steady and keep paper money going and keep the U.S. dollar alive, we're going to see just some very steady 6 to 15% years straight ahead. I mean, I think we'll average more than the 7.78 we've averaged for the last 48 years or 50 years. But to come in, so if you just take it, multiply it times 7 or 8% a year, and you're going to come up to 3,000 to 4,500 pretty quick. But that's the kind of numbers we're looking for. But keep your eye on a potential gold-backed currency that would force the U.S. to go to a digital currency. The last thing in the world you want is a digital currency, because the loss of your privacy and registering everything you spend over a certain amount It could be a nightmare, but that's another good story for gold because it is liquid. As Jerry said earlier, anytime you want to liquidate it, we can turn it and get you out as quick as you want out.
That's really good news. And when you bring up the digital currency, of course, that really isn't the topic today, but I'll just chime in on that for a minute and say that it is inevitable. Right now, according to the analysis I've seen, you have 114 different countries around the world that are exploring a CBDC or a central bank digital currency. You have 11 countries that have already implemented one, and then you have many more that are going to be releasing them or testing them, piloting them this year. So in 2023. So it's really interesting that blockchain technology, which came out less than 15 years ago. I mean, it came out in 2009, 2010, somewhere in there with Bitcoin and the advent of Bitcoin. Then now suddenly, Tom, not even 15 years later, you have all these central banks realizing how fundamentally groundbreaking this technology is, and they realize they want to incorporate this into their currencies. You're absolutely right that privacy is going to be the first thing to go, and that's going to be a big debate. But it almost seems like the genie's out of the bottle, so to speak. So yeah, these digital currencies, I think, are going to be a huge beneficiary for gold and for physical assets and for privacy, for asset privacy. So all that's coming. We can't really stop it, but we can position for it. And I think assets that provide some semblance of privacy are going to win. Think about the Fed balance sheet. We've been talking about the Fed and buying assets. They've been buying bonds. They were actually buying, corporate bonds not too long ago with the COVID stimulus they were doing. But now when we look at how the Fed balance sheet has grown since 2004, we can see that it's grown 1,100% since that time. During that same time, gold was keeping up with it mostly until we got into the mid 2010s. By the time 2013 or so came around, gold began to pull back, but the Fed just kept adding to its balance sheet. And now its balance sheet, of course, is enormous. It's never been this high. They've been slowly peeling it back now, but even then, it's still very, very extended. This chart between the Fed balance sheet and gold, I think, shows an imbalance. And I think it's also very bullish and a nice tailwind for gold because typically gold has kind of kept up with this. It hasn't as of late. So it has a lot of making up to do, maybe, is how we would look at it. And then also the gold and silver ratio, which is also a very interesting, it tells an interesting story. What do you think about the current gold silver ratio, Tom? Whenever you talk to clients and they talk to you about the ratio, what's your takeaway from it, and how can people use it to understand better when it comes to investing?
People use, think of it's 85 to 1, where it's been up to 120 something to 1 just in the last 24 months. But now it's back to the 85, and most people think it's headed toward 50. I think if you get a number of 40 gold in 2,000 gold and 400 silver, you'd have a 50 to 1 ratio. Some people like to use 32 to 1, talk about, and that goes all the way back to the 1960s. But we feel that right now, as you said earlier, not every investor that wants to be in the hard assets can get into gold, but they can usually silver. So it gives it a bullish background on dollar cost that gold doesn't have. And that's when you expect the ratio to go toward 50 to 1 as silver starts jumping. But on this rally that we're in right now, silver's being pulled up by gold in anticipation we're going to make it through the debt crisis over the next 6 to 9 months, and the Fed quits raising rates, and they even cut the rates a little bit to stay bullish. So you could see them separate. You could see gold go up to 90 to 1 or 95 to 1 if that happens, because gold will hold its own even if we're going to a world recession. It proved it every time we've had it. So silver, as we say, is a little more risky as an investment. And the ratio, though, when it starts going down, people believe they've got past the worst part, and they want to get in to get the ratio back closer to 70 to 1, and they'll invest in silver. But there's still a lot of unanswered questions in the silver market.
If you want to talk to Tom's office, talk to Tom about buying gold and silver, maybe talk to him about your current strategy, make sure you're on the right track. Maybe you need to rebalance your portfolio when it comes to owning some gold and silver or platinum. Give him a call, 800-247-2812. Also, don't forget to mention Follow the Money or this video, Jerry Robinson, myself. You can mention that and get free shipping and insurance on every order that you make through Tom's business. Now, we've talked about gold. We've talked about the dollar. We began to mention silver now. So let's get into silver, because I know there's a lot of people, Tom, who can access silver. Silver is so accessible. It's known as the poor man's gold. As you mentioned, not everybody can go out and just easily buy, lots of gold. It is sometimes a little cost prohibitive because of the price tag. But when it comes to having exposure to metals, well, it's fairly easy to get exposure through silver. And so when we look at silver in 2023, clearly, before we move into that, we're already bullish on gold. We've already said we're bearish on the dollar for 2023 and beyond. We are bullish on gold for 2023 and beyond. So let's move into silver now and talk about some of what we see as we head in. Now, I'll just briefly talk about this, Tom. I'd love to hear your thoughts as well. First of all, what we see is robust industrial demand. Even though the economy is slowing some, people just don't realize how fundamentally important silver is to technology, whether it's solar panels or whether it's other types of whether it's pharmaceuticals or whatever it might be. Silver plays a very important role, and we would even say it's indispensable. You really can't replace silver with anything, at least right now. And so as long as it remains indispensable to the global supply chain, as long as it is very important for the industrial economy, then it seems as if silver is just going to have continued demand for that purpose. And so you have the industrial demand, which gold doesn't have the same level of industrial demand that silver enjoys, because it's because of its price, it makes it much more accessible to industry to use it in their components. But then also you have silver playing that poor man's gold, that role of poor man's gold. So whenever gold begins to really rally, as you had mentioned, Tom, you said it was dragging up silver prices. Well, that's where most people will hop on, I would imagine, and you would know better than me, but it would seem like the majority of people may not be able to run out and buy 100 ounces of gold, tomorrow, but they certainly could go out and buy some silver and get and hop on the train for the ride in the uptrend. So because silver is the poor man's gold, and because we believe gold is going higher, well, silver could just benefit just simply from that. You also have the limited supply with silver. We've talked about that over the years, how there are discoveries occasionally, but the problem is that just like gold mining, mining is just a very difficult industry, and it's become more difficult not just because of fewer discoveries, but also because of new regulations. And mining is just a very difficult business in general. And so trying to extract new silver every single year and keep it above the demand levels, is increasingly difficult, to the point where we've seen some deficits recently. So that's what we see, Tom. I'd like to hear what you think whenever you think about silver in 2023 specifically.
The robust industrial demand is without question one of the major drivers of the silver market, both now and the foreseeable future. When you see China mandating electric cars by about 3 or 4 years from now, and you look at the solar panels, states like Florida saying all of our power for the future is going to come from solar panels, and they're investing millions of dollars in that. So there's going to continue to be a demand for the robust industrial demand, which is still over 50% of the silver market is industrial demand. So it is good for the poor man's gold to get in and cost average in and buy 40 coins here and 40 coins there, and, stock it up as you can, because it is indispensable. And even if you sold it as a industrial metal in the future rather than investment metal, you'd be getting a huge premium. And the limited supply is, we're hearing that silver is going to be the first major component depleted from the earth crust, and we could see silver a decade from now gone. And then what do you do with it? So, what do you do to change and get another product that'll deliver the same results? You don't know of one right now out there. So I love that. Now, silver, to give you a forecast, is crazy, because literally if we go into recession in the second or third quarter, we could see silver fall from the 24.50 it is now back down to 20. And that's worst case scenario. But if we get more, and these, Jerry mentioned right up front, we've got an election coming in less than 2 years. They're going to do everything they can to get elected. They're going to print money. They're going to give to every group out there. And you're going to see silver go all the way to 30, which is up about 30% for this year. And really, I lean more toward 30 silver than I do 20 silver. I'm not talking about for the long term. I'm talking about for the outlook for this year. But that's the one that's the hardest to price, because the world economy is going to be one of the drivers of it. Whether we have a recession, whether the U.S. Senate and Congress can work out a compromise on the budget. Because one thing that hasn't been said today, when you see that interest rate Jerry showed you up front, 0.08% up to 4% now, can you realize that on a $32 trillion budget deficit, and the interest rate, let's say it just goes up 3%, that's over $1 trillion new dollars in interest. $1 trillion in interest, not the debt, interest. So you look at it, and it's going to got some things coming. So if they try to keep the money flowing until the election comes in 24, you could see silver literally up over the 30s. But I feel comfortable saying 30, and that's, to make a prediction of something 25 or 30% up in 1 year is pretty strong. But that's what I believe. If the economy does what we think it will, they won't let it go into a recession.
Here's a historical annual performance of silver. We had looked at gold before, and we saw that it was pretty strong, at least going back to 2015. The same thing here. We had a bad year in 2015 where both gold and silver fell. But when you look overall, you see these numbers are, very, very strong overall, the green numbers. We've, again, slowed down over the last couple of years, or at least in 2022, where we didn't have a huge rally, but it was positive last year despite all of the carnage. Those who own silver didn't lose, any money in 2022. I think that speaks the same thing for gold. And so they did certainly play their roles there, where they preserved purchasing power in that case. And then when you look at 2023, we're already up slightly, at least as according to this. So silver certainly, Tom is saying, he sees 30 over 20 as we head into the new, this new 2023 year. I'm with you on that. I think that that's certainly a very reasonable place that it could go. Now let's just talk about where we are technically again. We saw something interesting on silver that looked like an inverted head and shoulders, for those of you who are familiar with patterns. And we had this right at the beginning of September, which actually ended up being the very low for the moment. And then we saw a nice rebound above that 200-day moving average again. So we want to stress that 200-day moving average, that gold line. We broke out above that line and then stuttered there for a minute and then took off again. But since that time, there's one more moving average on this chart that's very important that we follow, called the 30 SMA. This is the 30 single moving average, a simple moving average. And this is an area where we often find support when we are trending, when we're trending. It'll often act as a ceiling whenever we're trending down, and then it'll often act as a support level or a floor when we're rising. And so that's a very helpful moving average. What we've noticed recently is that we've gotten up into a real tight price action right in here, which is right below 24.50. That area, we're looking for a close above 24.50, and I mean a close above it. And what we've had is we've had lots of intraday pushes above that 24.50 level, but then it closes back below it. So this is a real meaningful resistance area we've been watching now since the beginning of December. We were looking for a breakout there. So we may spend some time here. We may even curl back down a little bit, technically speaking. It wouldn't be a big deal. We could even pull back to the 22 level and then bounce again and then retake that 24.50. Who knows how it's all going to play out. But we certainly have seen elevated volume. That is, a lot of people are beginning to enter this trade. On silver, we're starting to see some pretty good demand. Also, if you look at a monthly chart, this is an interesting kind of triangular pattern that you can see here forming on the charts, going back all the way 15 years now. And you'll see that same kind of pattern that we saw on gold, where the breakout level there for silver is going to be somewhere between 26, maybe 26 and 27, where you'll actually break out above a declining trend line that goes all the way back to 2011, where we peaked on silver near $50. And so a breakout above 26, let's call it 26, 27, somewhere in that range, that's going to be a fundamental shift in this 15-year trend that we've seen. Obviously, on the downside, it would be a break below $15, which we don't expect to see that. We would certainly expect to see more upside than downside, barring any kind of massive hard landing by the Fed and or as Tom had pointed out earlier, a really bad recession, which is not really what most analysts see. Most analysts see a garden variety recession. Assuming that we see one this year, that's what most of them are expecting. So the idea is that barring any kind of major economic slowdown globally this year, that's more than we already know, then we would say that silver very likely has more upside. And when you look at silver, for example, and do a ratio and compare it, say, to the S&P 500 going back to 2006, well, you'll see that silver certainly was trading at a relative premium to the S&P back at its height back in 2011. But now it's trading at one of the lowest levels that it's been on record. So silver relative to the S&P 500 right now is extremely, I would say, bullish for silver. Now, one more time, looking at a monthly chart of silver, a final chart here, this is where we were talking about that area that we really need to break out above. So we're calling it, anywhere between 24.50 all the way up to about 26.25 if we want to be real technical here. A breakout above this area is going to suggest that there's just much more upside ahead and more enthusiasm for this asset. But right now, we do need to clear that 24.50 resistance all the way up to about 26.25. Technically speaking, we will see, probably some pushback until we clear that area. So I think we've talked about silver quite a bit, Tom. I also want to get your thoughts on platinum. Did you want to add anything else to silver before we move on to platinum?
It's good. I think we did well on that.
Yeah, you did. You provided your forecast for that. I think we've done it. I only have one chart here about platinum before we move into the idea of how much to allocate. Because many people say, seeing gold and seeing silver and maybe even platinum, this all makes sense, but how much of my portfolio should be in this area? We'll talk about that in just a minute, so hold tight for that. But before we do, let's just consider one more chart, and this is a chart that goes all the way back for 20 years of the price of platinum. Now, platinum, Tom, many people may have heard of platinum jewelry. They may understand that platinum is used in vehicles. They may or may not know that, but platinum is certainly much more scarce than gold or silver, right? I mean, platinum is a much different kind of metal. And maybe we should ask, what are your thoughts on platinum as we go forward? But also, who is this metal right for? We know that gold makes sense for the person who is wanting to have portfolio insurance. We know that silver is for the person who's wanting a bit more risk when it comes to and wants to perhaps have a bigger gain, if gold does well. But platinum, help us position that properly for the investor. Who is platinum good for? Who should not invest in platinum? And what do you see ahead?
Now, to start with, you're looking at a platinum that was, when we first gave a buy signal on it, $300 an ounce back in 2000, roughly, because everybody was going to catalytic converter. We're switching. The Clean Air Bill had come out a few years earlier, and there was a big demand for platinum. So we saw this big spike up. And then when they found another metal, palladium, that could do in a catalytic converter what platinum could do, we saw that. So platinum has been to 2000. It's been to 2000 before, from 300, and a lot of our clients participated in that. Today, platinum is 50 times more rare than gold. It's not a monetary metal. It's not to be looked, but the people that are buying most of the platinum from us are doing it in there's two asset allocations. There's one for your total portfolio. You have 50% in this, 30% in that. I'm talking about stocks, bonds, real estate, foreign currencies, hard assets. And then you've got the diversification within that. So let's say you decide that you want 20% in hard assets. So then you come in, and most people that are buying platinum they're spending 40, 50% on gold, 20, 30% on silver, 15 to 20, 25% on platinum in their asset allocation of precious metals, which is within the asset allocation of the whole portfolio. So that's our biggest business. But see, now, when we gave a buy signal on palladium, it went all the way from 400 to up to 3,000. But it's dropped back now, and we don't recommend it because we feel that platinum and palladium will come together in somewhere around 1,500, probably in this fiscal year. So, it may come a time we move back to palladium because you can buy it in coins and bars just like gold or silver or platinum. So that's the primary user for us is the guy that does more allocation within his hard asset allocation. He wants it in there because if you'd have put a chart up showing what platinum did for 2003, how about 10%, not 1% like gold, or minus 10% like the Dow, or minus 19.5% with the NASDAQ, it went up 10%. We have a lot of happy customers buying platinum on diversification within their hard asset portfolio.
Tom, would you describe yourself as more bullish on platinum than you are silver or gold, or would you say, well, how would you qualify that?
I'd put silver this year. I'd put going in what happens after this year. Because like we said, we don't think there will be a severe recession. Could be a 1/4 minor recession. But platinum is just kind of get in because it's going to come back in car usage when it gets back up to 1,500. It's kind of like gold and not as much diversification yet. It's not being driven by investors at all. Very small percentage of the thing is investors. It's primary industrial users that are stocking it up in the airline industry, in the catalytic converter industry for the future. So you're really talking about great diversification within a diversification by putting some of all that in there. Now, there is a little higher premium over spot to buy it, but when you have something that's 45, 50 times more rare than gold, and it's going to be more costly to refine, and it's not as big a part as these refineries' operation.
I know many of our viewers will appreciate your commentary on platinum because it is an exciting story when you read about platinum and you see what the possibilities are. It is a pretty exciting metal. So you obviously sell platinum, palladium, gold, and silver. So anyone has any further questions on that, they can certainly reach out to you. Now, let's bring this to a conclusion here slowly as we consider a couple of things. The first thing is that it's important to note that when you're determining the right amount of gold per se for your portfolio, it really depends upon individual financial goals. It depends upon risk tolerance. And so let's just go through a few of the considerations that you want to think about. Say, this presentation sounds good. Gold and silver seem to be something that I'm lacking in, or maybe I need to add more. And so how much of my portfolio should be in gold? That might be a real common question, or silver or platinum. Well, let's just go through some of these. First of all, your long-term goals or your investment objectives. If you're saving for long-term goals such as retirement, it may be appropriate to have, a higher allocation of gold in your portfolio so that it can act as a hedge for you, as Tom has been pointing out. Also, diversification. Gold helps you diversify your portfolio, reduce your overall risk of your investments. It can help reduce the impact of a downturn of other asset classes, just like we saw in 2022, where those who had some gold or even silver in their portfolio enjoyed pretty much a wash or slightly positive, whereas people who owned stocks or even bonds, suffered greatly. So diversification also needs to be a consideration. If you already have plenty of gold and silver, well, maybe you've diversified well enough. Maybe you don't need to do that. But if you don't have any, well, then certainly this would make sense to take a look at. Asset allocation, of course. One common approach when it comes to investing is to just kind of consider a percentage of your overall portfolio. And one widely used rule of thumb is to allocate around 5 to 10% of your portfolio, to precious metals. Me personally, I invest 15% of my total investable assets into hard assets, into tangible assets, not real estate, but I'm talking about commodities and other tangible assets. And so gold and silver are part of that 15% of what I have. But that's just me. That's not you. You have to find that. You have to find that percentage that's right for you, and quite frankly, that's best done within the purview of a financial advisor who is trained and licensed and can help you make those decisions. So then also risk tolerance. If you're comfortable with higher risk investments, then you may want to consider allocating a smaller percentage of your portfolio to precious metals. But if you prefer lower risk investments, then you may want to consider allocating a larger percentage of your portfolio, because again, gold really is that portfolio insurance. And so the percentage that you put into it really needs to be based upon several different ideas. And then also your financial situation, right? So your current financial situation, your income, your current assets, your current debts, that all has to be taken into account when you're deciding how much to invest in precious metals. So, if you're up to your eyeballs in debt and you need to pay that off first, well, obviously you need to prioritize your financial situation and make sure you're making good decisions. So these, of course, are not a replacement for talking to a trusted financial advisor. That's what we recommend to you. But when you're thinking about how much should go into this space, these are some of the considerations that I think would be helpful for you to consider. Now, Tom, we did have one question we want to end or conclude with, and this comes from Janet P. She's a gold member from Idaho here at followthemoney.com, and she knew we were going to be doing this video, and she had a question. Tom, do you recommend gold bars, coins, or rounds? There's so many different choices, and we could probably say the same thing for silver too. She didn't ask about silver, but maybe you can address both of them. When somebody calls you up and says, look, I've decided to put X percent in gold, for example, if they're not savvy to all of this and they don't really know, how do you guide them on whether they do bars, coins, or rounds? What are the considerations there?
First consideration is how much they have to spend for that particular asset. Gold bars, I'll put everybody in kilo gold bars. They're 32.15 ounces, and we can get them in like 3% over spot, including us, shipping, wholesaler we buy it from. I would do kilo bars. Almost every large investor we have, they're buying kilo or 10-ounce gold bars because, number one, they're COMEX, so they can be used as collateral for future trades where coins or rounds cannot. So larger investor Gold bars. That's what I would buy. The biggest you could afford. Coins are great. They can make you develop something that you like looking at. You may get a 1 ounce gold eagle, a 1 ounce Canadian maple leaf, 1 ounce Australian kangaroo, 1 ounce Krugerrand, South African Krugerrand. And we've had people every time they order a coin or two, they get a different one. Like it's become very popular now to buy Britannias because Queen Elizabeth passed away, and they'll be changing on the country's mint to King Charles. He'll be on the front of the gold coins. So there's different ways to do it, but rounds are what you want in silver and not gold, because the rounds are not as accepted, because you really lump the coins and rounds in the same basket for silver, where in gold there are companies that do make just rounds, or silver that make just rounds. Excuse me. So that's what I would do. I'd go with that. But the coins are going to be the coins or rounds are what you want for silver. For gold, you want the gold bars or coins.
That's very, very helpful. And when you call Tom Cloud, you'll be able to discuss that with him. So you can get all the prices for gold, silver, platinum, palladium, whatever it is that you're looking for. And you can ask them, what are the price of the bars? What are the price of the rounds? What's the best deal that you have? And Tom, you have specials all the time as well. So sometimes you may recommend something that maybe you wouldn't normally recommend, but it's just such a good deal that they really should go that direction. So who knows what your specials are on any given week or any given month, but the best way to find out is to give you a call, 800-247-2812. Tom, as we wrap up and conclude today's presentation, do you have any final words for those who may have questions for you before they call?
I mean, certainly you can do all the homework you want on it. It all gets down to price and service and dealing with people who've been out here as long as we have. And I think our service to our clients is second to none. I think I get nice compliments all the time on clients that talk to Catherine or Dan, who's been with me 20 plus years. But I just think they need to think about what we talked about and just realize, to look at gold as insurance and that diversified confidence we talked about early on and getting there. And the last comment I'll make is the last one you made about what you buy. And we're spending more time than ever because we know so many major wholesalers that do bid ask, and sometimes their bids get hit for more than they anticipate. They may want to buy $100,000 of maple leaves, but their bid gets hit for $150,000, so they have to buy the $150,000. So then we get a call and say, "Hey, we'll give you a % discount on this if you take an allocation of this." And this has been the biggest thing. Clients have been blown away that we'll take the time to try to save you 1%. So if you save 1% up front and you compound that out 7% a year, we've saved you a lot of money. And that's the thing that we never talk about, but that's one of the proudest things that I have is developing a relationship with market makers that are willing to call us and say, "Hey, before we post it to other people in the business, we're going to give you a head start." And that's been very, very strong for us. It's helped us get some nice sized clients.
This has been fantastic, Tom. You've really provided us a lot of detail. I think the combination of your macro experience, seeing many different cycles, coupled with our charts and the things we've talked about today, are going to benefit those who are listening. I do want to encourage you to support Follow the Money by giving Tom a call. He has been a sponsor here for more than 10 years, and our customers and members just couldn't be more satisfied. We always hear good things about those who deal with Tom Cloud. You can call his office, 800-247-2812, and his office is standing by. If you happen to get a message, it means they're probably busy with somebody else on the other line, so just leave them a message, and they will call you right back. And for those of you who want to learn more about Follow the Money, you just go to followthemoney.com. There we have, as we mentioned, all of the charts that you saw today. Many of the charts you saw today are things that we create for our members. And so if you want to become a member here at Follow the Money, you can click the plans and pricing. You can start a 7-day free trial and learn more about the work that we do here. But Tom, this has really been fantastic today. I think everybody who took time to listen to this is really going to benefit. And I want to encourage them to reach out to you if they have any questions. So once again, my friend, I want to thank you for your time today. And sure do appreciate working with you. It has been a wonderful joy over the last decade.
Same with you, Jerry. I love working with you and your wife and family. And let's keep it going and stay educated on what's going on in this world.
All right, my friend. God bless. And we'll look forward to seeing you next time. And everybody, thank you for tuning in today. God bless, my friend. And thank you all for tuning in.